All right, let's get right into it. We're talking Natural Resource Partners, or NRP, and their Q1 earnings call on May 6th. What happened with the stock that day was a total head fake, and we're going to break down exactly why it went down the way it did.
So check this out. The call happens before the market opens, and at first, Wall Street seems to love it. The stock pops almost 3% at the opening bell. But then, it did a complete 180. By the close, it was down nearly 4%, and on a huge spike in trading volume. You're talking about a 7-point swing from the high of the day to the low. Just brutal.
So the big question is, what on earth happened between the opening bell and the close? What did traders see or hear that turned a good morning into such a terrible afternoon for the stock? That's the mystery we're unpacking today. Let's start with the good stuff, the bull case. This is the story that management was really trying to sell, a story all about financial strength and a huge reward for investors that's just around the corner. First off, even with commodity markets in the tank, this company is still an absolute cash machine. They cranked out over $35 million in free cash flow in one quarter. That tells you that the core business is incredibly resilient, even when everything seems to be going against it. And all that cash has a purpose. See, for nearly a decade, since 2015, they've been on a mission to pay down debt. And look at this, they're almost there. Just $139 million left. They are right at the finish line of this long, disciplined journey. And with so little debt, their balance sheet is basically a fortress. A leverage ratio of just 0.7 times. That is rock solid for this industry. It gives them a ton of flexibility, a ton of security, and this was really the cornerstone of management's positive message on the call. And here's the carrot they were dangling. The COO, Craig Nunez, came right out and said it. Once that last bit of debt is paid off next year, expect significant increases in distributions to shareholders. You can see why the stock popped at the open, right? This is the big payoff everyone's been waiting for. Okay, but then the market started digging past the promises for next year and looked at the cold, hard facts of today. This is the bear case, and this is where that pretty picture starts to fall apart. And I think this is the number that just sent a chill down investors' spines. The cash they got from their soda ash business absolutely collapsed. I mean, it fell off a cliff, down a staggering 80% from last year, from $15 million to just $3 million. That's not a dip, that's a disaster. And it wasn't just soda ash. The quality of their revenue from coal is also getting worse. A year ago, the good stuff, the high-value met coal for steelmaking, made up 75% of their royalties. Now, it's down to just 55%. That's a huge shift, and it points to some serious weakness out there. And management didn't try to sugarcoat it. They were brutally honest. They said they expect weak prices for met coal, thermal coal, and soda ash to stick around for the foreseeable future. When the market hears that, it hears one thing: the pain isn't going away anytime soon. Then they really twisted the knife on soda ash. They said they think we're in the early innings of a bear market that could take multiple years to fix itself because of a global supply glut. So this wasn't just a bad quarter. This was a warning shot that a core part of their business is in for a long, tough slog. So you've got these two totally different stories, right? On one hand, a perfect balance sheet about to unleash a flood of cash to investors. On the other, a brutal market environment that's hitting them from all sides. So let's talk about what could actually change this story. And really, this is what it all boils down to. You have a fantastic company, a real cash compounding machine that's just stuck in a really, really tough market cycle. The whole investment thesis here is whether that fortress balance sheet can act as a bridge, to get them safely across this chasm to the other side where the market recovers. Now management also mentioned some of their other projects, these carbon neutral initiatives. The best way to think about these, they're basically lottery tickets. They're low-cost bets on future businesses like CO2 sequestration or lithium. They could be huge, but management was very clear. The timing is a total question mark. Don't count on cash from these anytime soon. So as we look ahead, here are the 4 big things to watch. 1, do their coal numbers actually come in as weak as they guided? 2, do we see any signs of life in that soda ash market? 3, do any of those carbon neutral lottery tickets actually turn into a real project? And 4, the big one, when do they officially kill the debt and tell us exactly what that new distribution policy looks like? All right, let's put a bow on this. How should we be thinking about this stock heading into the next earnings call and beyond? Let's break down the whole setup. Here it is, all laid out.
The bull case is all about that amazing balance sheet and the promise of a massive cash return in 2026. The bear case is about the ugly reality of commodity markets here in 2025. The market sold off because for one day, it decided to stare only at the problems on the right side of this chart.
And that right there is the big idea, the potential trade. The market's reaction feels really short-sighted. It's punishing the stock for the 2025 downturn that everyone already knew was coming, and it seems to be completely ignoring the massive, game-changing capital return story that's coming in 2026. It's a classic case of not being able to see the forest for the trees.
And because of that disconnect, our rating here is outperform. But, and this is a big but, you absolutely have to be patient. This is not a bet on the next 3 months. This is a bet on the company's big shift from playing defense with its debt to playing offense with shareholder returns starting in 2026.
This is not financial advice.